We are looking at all the different parts of the market that could be impacted by next month's election results. And tonight, we are talking bonds. Our next guest says a big blue wave could spark a major move in the Treasury market. Let's bring in Kevin Gittes, Chief Fixed Income Strategist at Raymond James. Kevin, great to have you with us.
Thank you, Melissa.
I mean, the assumption is that Democrats spend more money, right? We're going to have a bigger deficit. There's going to be more debt issue. I mean, is that sort of the logic behind this?
Yeah, it really is. And of course, we went through this in 2016 with expectations going into the election and then getting a different outcome, which really shook up the fixed income market in particular. I think fixed income investors, it's a different time period and they go in with a different view. So assuming a full blue wave is a Democratic president and a Democratic Congress, you would expect higher taxes. You would likely expect a bigger stimulus package. And the combination of a bigger stimulus package would likely bring the economy back stronger, but it also may bring inflation with it. So most of those, with the exception of the muni market, would be negative for the fixed income market, the taxable market in particular, and treasuries. So it's just, may not end up that way, but that's the way it sets up, at least in the investor's mind right now.
In your view, are yields telling you how the market is positioning itself?
Yeah, it's, in the fixed income world, we look at really just 3 dates. We look at the pre-crisis period of mid-February. We look at the complete fallout of middle to latter part of March, and we look at what's happening today. So right now, while spreads have contracted quite a bit and continue to contract, volatility is starting to tick up, which means investors are getting a little bit worried as we approach the election that maybe they need to hedge some of these ideas as to what's going to happen in the future or what's going to happen next year. So, I kind of think that we're going to start to see volatility go up. I think we're going to see a little bit of uptick in yield as we go into the election until we have some certainty. And who knows whether we get full clarity on election night.
It's Karen. Thanks for being on. Let me ask you about the dollar. Is the weakness in the dollar already sort of pricing that in for a blue wave?
Yeah, I think so, Karen. I think that we're starting to kind of see a trend develop here, but the dollar has kind of been up and down all year, and I think we would see, because the Fed is just controlling so much of what's going on in the rate structure, that weakness in the dollar has been with us and not likely to hurt us so much if we see the blue wave. But it is a factor that we're going to pay attention to especially the last week before the election.
Hey, are you thinking about, you saw that trade data last week. We had the biggest trade deficit since 2006. Do you think a blue wave also means that we get rid of some of Trump's tariffs here? And that would also be something that could help offset possibly higher taxes in 2021 or 2022?
Yeah, so, the taxes you would potentially remove the tariffs and then add taxes to both individuals and to corporations, and you would offset some of that issue. But I think that we're in a different period in the sense that you're not going to be able to turn the economy on in the middle of a pandemic or towards whatever stage you think we are in the pandemic. We still have to fight the medical health care issue while we're trying to bring back the economy. So I don't think it just is as simple as flipping a switch here and flipping a switch there. Boom, we take off and everything's good again. So I think if we were further along or we had a vaccine that we were ready to roll out, I might change my mind about what are the levers that are going to change where economic growth is going to be and what it means to interest rates.
We've been talking about the blue wave scenario, Kevin, but what happens if things are fairly status quo after the election?
So there's a couple of scenarios, and we saw this in 2016 when it kind of went all Republican, and then we saw a split of Congress in 2018 and what happened to the markets then. So, you can make a certain amount of assumptions. Well, let's just deal with the one that we have now, that we'll continue to have a split Congress as we go into the next 2 years. The markets aren't going to be really upset by that. There may be a chance that you see some increased taxes, but we're likely going to see the same battles that we're fighting now well into the next couple of years. And I think that's, I don't know if anybody saw the speech that Richmond Fed Barkin gave today, but he talked about virus uncertainty, political uncertainty, and fiscal uncertainty. It's really hard to get an economy going during those times. We still have those uncertainties. And I think if you split Congress, no matter who wins the White House, that's likely where we're going to live for a while.
All right, Kevin, great to speak with you. Thank you.
Thank you.
Kevin Geddes. We've been talking about the weak dollar for some time, Tim. Goldman Sachs, I believe, came out with a call earlier this week saying a blue wave could mean dollar weakness to levels we haven't seen for a couple of years. What do you think? What do you think the election impact could be?
Well, first of all, I think as long as, Kevin also mentioned the Fed, and I think the Fed that we have is going to, whether we want to or not, keep rates pinned. And the Fed says they want inflation, but in fact their policy is deflationary. So I think no matter what we have, look at the rest of the world also. Look at where yields are around the world and the positive carry trade for investing in the U.S. and borrowing in yen. I think that's going to continue to dominate. Unfortunately, I think yields moving up 50 to 100 basis points would be a great story because it would be more indicative of really what's going on with the overall economy. And that the minute the Fed begins to unwind some of the stimulus, if they ever do, and again, we've had these periods where we have had the ability to take away extreme accommodation and they've done nothing. I think the dollar is range bound. I think we've seen it vacillate essentially between 80 and 110 on the Dixie, but 100 seems to be the high end, and I think somewhere around 82, 83. The bottom line is if you think the dollar is going to continue to weaken, you want to own emerging markets, you want to own commodities, you want to own resource plays. And those, if you look at EM, is just kicked back up to almost 2-year highs. So while an area I've invested in much in my career, and I'm not saying go out and buy it blindly, I think you have to take a look at some of those if the dollar continues to weaken.
Shepard Smith here. Thanks for watching CNBC on YouTube.